Listen up, because 153,000 Americans are about to get surprised with pink slips just in time for the holidays. And no, this isn't the AI hype train derailing jobs. This is the ugly truth that I've been warning about of a slowing economy, because now it's starting to break. And remember that brutal cash crunch we've been talking about, where low-income folks can't even afford McDonald's? Well, as I predicted, and this is the proof, it's not stopping there. It's surging right up into the middle class who thought their jobs, investments, and futures were secure. But now it's all about to change. And here's a game-changing twist. If you ignore this now, it means your family's finances could be next in line for the wrecking ball. So stay tuned, because this is your wake-up call to protect what's yours before the real storm hits. According to Challenger Gray Christmas, U.S. companies announced 153,074 job cuts last month. That's almost triple the number in the same month last year, and driven by the technology and warehousing sectors. In fact, it's the most for any October since 2003. But hold on, these aren't immediate actions. They're announcements, meaning the real pain for these workers is going to hit in 2 to 3 months. And the problem is, they don't know it's them. And this is coming just in time to ruin Christmas and kick off a new year with empty wallets and mounting bills for tens of thousands of American families. And sure, it's technology. We can blame AI because it's the villain that's going to disrupt everything. But don't forget the post-pandemic hangover. If you look back, what did companies do? They overhired like crazy. Then they poured billions into this AI hype without seeing any real returns. And so what this is forcing them to do is slash payrolls, because they have to keep funding the arms race. At the same time, they've got to keep buying their stock back to keep Wall Street happy. And then there's warehousing. Now, this is the real curveball here, because what it's signaling is a bloated supply chain that I've been warning about is stuff full of inventory that's just sitting there and gathering dust because consumers aren't buying. In fact, consumers don't have the money to buy it. And that's why we're seeing some industries are correcting after the hiring boom of the pandemic. But this comes as AI adoption softening consumer and corporate spending, and rising costs drive belt tightening and hiring freezes, according to the Challenger report. Those laid off now are finding it harder to quickly secure new roles, which could further loosen the labor market. So we come back to that cash crunch, this liquidity crisis that I've been hammering on now for a while. You can see it's directly affecting low-income consumers. They can't even afford McDonald's. And I warned you it was going to bubble up, and now it's starting to hit the middle-class workers. And again, they thought their jobs were steady, their 401ks were going to be great, and their future was untouchable. But all of a sudden, it's not just AI, it's the timing of a slowing economy and weakening consumer spending. And what we're finding out now in this weak jobs market, where a lot of people get stuck on long-term unemployment for months on end, those that are about to lose their jobs are going to find out that their too are going to be on the sidelines with zero potential for re-entry. The problem is, my friends, it's a vicious cycle where demand destruction leads to more unemployment and more demand destruction. Now check this chart out on the screen. This is the ugliest October layoff spike since the dot-com era exploded, because I've warned you, without a blockbuster holiday season, and you can only imagine for these 153,000 as they find out they're going on the unemployment line, their spending is going to get cut. And what's going to happen is these companies aren't going to hire if consumers don't come out and spend. In fact, they're going to come out and fire even more. And Challenger's echoing that, as it says it's even possible with rate cuts and strong showing in November, the companies may make a late season push for employees. But at this point, we do not expect strong seasonal hiring environment in 2025. So what you're seeing is a textbook prelude to a full-blown financial crisis, which is why you're about to witness a layoff tsunami that's going to bring the economy crashing down after the first of the year. Now, we've been staring down a barrel of house of cards economy here, and one that's been completely propped up by skyrocketing stock prices that everybody's looking to say, look, the economy's fine. Because as we start peeling back the layers, we find out the economy is teetering on the edge of collapse, and it's ready to drag banks down, and Americans right along with it. Let's peel back the layers, because the share of U.S. consumer debt and delinquency has now risen the third straight quarter to the highest level in more than 5 years, as unpaid student loan balances continue to surge. So for these workers, for these students, for these borrowers, it means there's going to be wage garnishments, seized tax refunds, and their credit scores, they're going to get crushed overnight. Now, for the broader economy, this spells absolute disaster, because as these consumers have less disposable cash, it means they have less money to spend, less money that circulates in the economy, and leads to an accelerated slowdown. Now, I want to give you a quick update on that trade we put out a couple of days ago to our CTA Timer Pro subscribers, and I want you to see just how easy it is to make money in this market. Because while a lot of other systems require you to sit in front of your computer all day, my subscribers, they got stopped out for a quick 1.87% gain. And as we step back and look at the markets right now, we can see they're on the cusp of selling off. Volatility is about to go up, and for my subscribers and my system, it means huge opportunities, not just to take advantage of the move down, but to buy back in at the bottom. And here's the great part, you can join us too, because we're making a lot of big updates. In fact, our next update, we're going to be building in volume profile data. This is something other trading systems do not have built into it, but we're going to. Now, whether you're an experienced trader or brand new to trading, all you got to do is grab those links in the description below and use a coupon code to get your free 30-day trial. Because I'm convinced after 30 days, you're going to see why our system is so much better. There's also a video that walks you through exactly how it works and how to use it. Now, around 4.5% of debt was at least 30 days delinquent in July to September. This is the most since the first quarter of 2020. In fact, the share of student loan debt becoming delinquent has now climbed to 14.4%. That is the highest on record. And this is no coincidence that this aligns with the McDonald's double-digit sales plunge we talked about yesterday, because it's affecting low-income consumers who are loaded up with student loan debt. So what we're seeing right now is they're tapped out in a big way. And what this is going to do is lead to a brutal pivot in the economy, because what we're seeing is borrowers aren't ditching payments by choice. They're being forced to because inflation is outpacing wages, hours are getting slashed, and jobs are vanishing. Now let's take a look at a staggering chart as we look at transitions into 30-plus day delinquencies. You can see it's just surging to record highs here. It's off the charts. And the problem is, for low-income Americans, inflation's running too hot, despite the fact that the Fed is starting to say otherwise. And what this is a clear red flag of a weakening labor market that starts first with hours getting cut, just as they said it would. And now we find the evidence is here that consumers have been validating this all along. Let's turn to the University of Michigan Consumer Sentiment Survey that's shown in blue against average weekly hours of production and non-supervisory employees. And you can see very clearly where hours go, sentiment follows. Now the problem is we've seen sentiment decline, but absent the government payroll reports, all we can now do is believe that hours are going to continue to go down. So this is a problem because the evidence is from the consumers that this drop in confidence was in direct response to the fact that they knew their hours were going to get cut. So what we're seeing is delinquencies are slamming hardest into 20 and 30-year-olds, and all this is doing is fueling that 153,000 white-collar layoff wave all the way back from October, and it's going to ramp up even more as we head into the new year, because reemployment is going to get tougher and more companies are going to look to lay off. And how about the Fed? Well, they're utterly clueless. As Fed Chair Jerome Powell said, he was paying close attention to credit conditions following recent reports of significant losses at subprime auto institutions, but added he didn't see, quote, at this point, a broader credit issue. I don't know how he cannot see this, because by the time the Fed wakes up into the reality of what's going on in the economy, it's going to be game over. They're always too late, because if you think about the issue here, lower rates aren't going to save us, because the root issue here isn't borrowing costs. That's not why people are going into delinquency. It's because their incomes are shrinking against relentless inflation. And rate cuts, well, they don't make people's incomes go up. And here's the proof things are going to get worse. Let's turn to this chart of the delinquency rate on consumer credit card loans. That's shown in blue against average weekly hours of production and non-supervisory employees, still shown in red. You can see very clearly when hours worked go down, the delinquency rate goes up. And that's exactly the anecdotal evidence we have right now. So what we're facing here, as paychecks go down even more, that delinquency rate is going to surge well past just credit cards and student loans. And so now what we're seeing is we turn back to McDonald's. This is exactly what they've been warning about, and now we can see they're not the only ones, as Papa John's is bleeding too. In fact, Papa John's international shares dropped after comparable sales unexpectedly, I love that, shrunk, and the pizza chain slashed its outlook as diners, as particularly low-income ones, skipped on dining out. Well, it's obvious. They didn't have the money. Now, this was not unexpected. We saw this coming because right now the problem is companies are looking at the stock market for a barometer of the health of the economy. And the real issue is they're not listening to their customers who have been complaining about higher prices. Because most of the sales decline came from customers cutting back on sides, noting there's a disproportionate sales pressure among lower income consumers. Now, can Papa John's fix this? Well, they think they can. They think the answer is cheaper sides. But come on, Papa, that's a little too late. Especially when you look at Challenger's layoff data, it's suggesting it's hitting the middle class next. And that means, of course, you're going to find that even more of your consumers, it's not going to be about sides. It's going to be about not eating out at all. And it's rippling outside of fast food because CarMax just ousted its CEO amid plummeting sales, as their preliminary outlook for the third fiscal quarter includes an 8 to 12% decrease in comparable store unit sales. And as more people hit the unemployment line, demand for cars and jobs tied to the automobile sector are going to crater. And what you're facing now is an economy that is entirely vulnerable. In fact, check this out. 50% of the total U.S. consumption right now is being propped up by the wealthiest 10%. That what this does, it makes this whole system, our whole economy, a big giant Jenga tower ready to fall over. And it makes the economy highly vulnerable if anything goes off the rails for those high-income, high-net-worth households. This is from Mark Zandi. He's a chief economist for Moody's Analytics. He goes on to say that a downturn in the stock market would knock the wind out of those high-income households, and they're the last pillar of strength in the economy and raises the risk of a recession. And so all those skeptics who keep saying that stocks can never go down or are just going to continue to roar higher, remember, I want you to keep this in mind. Where incomes lead, profits and stock prices, they follow. Let's take a look at this chart of the NASDAQ 100 in blue. We've still got average weekly hours of production, non-supervisory employees in red. And you can see very clearly the two go together. Now, the problem is right around 2023, the stock market took off as everybody thought they needed to buy the dip. Meanwhile, rank and file average American families were falling further and further behind. And the issue here are those two lines, well, they've got to come together because only one of those trends can win. Either hours worked need to go up or stock prices need to come back down. And the reality is for low-income Americans, the situation is getting worse. And for middle-income Americans, well, they're about to face a hard reality. The 153,000 of them are about to lose their job. And again, my friends, this is just the tip of the iceberg. Now, the issue is here, this isn't just isolated. It's the confirmation point where AI-fueled firings meet consumer debt bombs and inequality chasms, building into an economic cliff that could redefine our entire economic prosperity as we know it today. Now, here's a brutal path. This AI-fueled layoff surge, paired with exploding delinquencies and consumer pullback, is a tipping point not just for a recession, but potentially for an all-out financial crisis. And you can hear the whispers at the door. It's coming and fast. But you can fight back starting today. Here's what I want you to do. Build that emergency fund cash buffer. If you can get to 6 to 12 months of expenses, that's awesome. Lock it into a high-yield savings account. Remember, the Fed's going to be cutting here in the coming months. You want to lock in those rates while you can. Consider diversifying your portfolios. It's time to start shifting to defensive plays. Cut out those high volatile positions and start looking for things like utilities, consumer staples. Look to buy gold on major dips. Remember, second rate cut, still bearish for gold here. And third, you want to go hunting for some undervalued assets. Maybe look for beaten down bonds or dividend aristocrats. Look for things to grow your wealth on the rebound. And don't discount the dollar or treasuries here. They could be high flyers. And how about your skill set? Well, it's time to upskill in a big way. So learn some AI-resistant trades and safeguard your income while you still can. Because I don't want you to wait for the crash. I want you to get ahead of this mess now so you can come out stronger and wealthier than ever. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.